U.S. Federal Reserve preparing to deliver its latest rate announcement. Inflation, though, remains sticky south of the border. Let's dig into the state of the economy, everything that the Fed is looking at, and sort of try to answer that question. Are cuts still on the table for this year? Joining us more now, Chris Whelan, Senior Canada Rates Strategist and Head of Portfolio and ESG Strategy at TD Securities. Chris, welcome back to the program.
Thanks, Greg.
All right, so we know, for the most part, what documents they're carrying into those meetings that they get poured over. We've seen the data they're going to access. Let's start breaking it down. Let's start with the job situation in the States.
I think, well, we just had a really strong jobs number last week. So I think the data is I think the market is complacent for this meeting in terms of what's going to happen because the data has been holding up pretty well. So the question is really when the data is going to eventually break. And I think that's what's made this year so difficult for forecasting, and we're managing around what the Fed is going to do. And I think in the beginning of the year, there was a lot of thoughts that they would start cutting much sooner or that they would have already cut by now, and that was good for equities, that was good for corporate bonds, and now we're in this mid-year state where we weren't sure if we were going to be higher for longer, and so now we're kind of higher for longer versus are we going to fall off soon? So I think we don't have too much expectation for this meeting to be. Have a ton of fireworks. I think this is more of the quieter meeting. Whereas, talking to our U.S. rates team this morning, they emphasized that we have about 4 CPI prints before the September meeting. So we got this week, and then there'll be 3 more right before the September meeting. That's a lot. That's a lot of CPI data for them to digest before they head into the September meeting. So I think September is the bigger deal. Jobs definitely was looking strong as of the last report. Actually, was a big market mover last week. So yeah, it's really the U.S. economy just continues to hold up well. It might just be the power of 30-year mortgages.
Yeah. And not quite as sensitive as we are.
Right.
To these
things, and Australia has the same dynamic as Canada. UK does. So that lower ability to lock those in longer term can make it a little bit slower moving. It's certainly going to start to hit autos and other things like lines of credit and different other forms of financing hits those first. But I think that's the story that's really showing up. Whereas in the Canada front, our GDP is is not nearly the pace of the U.S.
We had that headline jobs number you said coming in much stronger than expected. Yep. Of course, you get into the details of a jobs report. If we're worried about inflation, we worry about wages. What's it looking like south of the border? Are they still making gains?
So I think the question becomes when you start seeing the strong jobs number, will the wage inflation keep up, or is this kind of short-lived? So I think there is not an easy answer there right now. But certainly, and if the job pressure is there, you can have the wage inflation pressure there. But it depends if you have a quick shift, and finally there's an economic shift and kind of we slow all of a sudden, then you're going to have the wage pressure isn't going to be there. But certainly wage pressure has been there, and certainly the jobs have been robust. So it's if looking at that in isolation, that's a pretty compelling story for rates staying higher for longer. So to be determined. Jobs can also be a lagging factor. Wage inflation can also be a lagging factor. So a lagging indicator. So to be determined, and kind of comes back to. It is not an easy environment to make a call on or navigate through this kind of economic environment and where we end up. It's I guess longer term it's probably easier, I think, because the heavy debt loads eventually do weigh on an economy, but it's how long those take. And so I think that's the hardest thing that for anyone to call, and this year has really magnified how hard it has been.
Yeah, part of that challenge, obviously, is American exceptionalism, has been called.
Yes.
How strong the economy has been. But you threw out something interesting there, the fact that could it turn and how quickly could it turn. Is that another thing, too? Is like at some point, does the U.S. economy suddenly not react so exceptionally? And then we get this turn and we'll be almost, not caught blindsided by it, but almost like, wow, that was quick.
Yes. So that's kind of, we have a history over like the last 35 years. I've seen a chart before where the market tends to expect higher forward rates than are actually realized. However, for this cycle, the market did not forecast rates to be as high as they went. So this is a little bit different right now, which kind of speaks to, are we in a new regime going forward, or is it kind of back to the old way and this is a blip? So we'll see. But long story short, a lot of times, generally speaking, in forecasts that are made, a lot of people don't forecast a crisis or an economic or something or a crack.
I guess what someone called the black swan, right?
Yeah,
you don't know it until it's arrived.
Yeah, I think it's going to come in Q3. Like,
Yeah.
no.
We got it penciled in.
We got penciled in. We think it's coming in Q3. But we don't know what it is. So so sometimes those are the events that can actually bring rates lower and trigger these things. But at the moment, it's hard to find what would be the trigger, and the consensus is that kind of like a progressed gradual slowdown, and I think that's the general take right now. So, well, where that brings, I think we're confident that brings interest rates lower. Just exactly. It's a matter of time. But can it slow pretty fast? Yeah, things can slow pretty fast. Like you get to a point where everybody's doing the best they can to keep up with spending, and then all of a sudden they just can't keep up anymore. And I know that I think it's a global phenomenon that everyone is feeling an inability to keep up with where inflation and goods went. So I think it's just a matter of when that moment happens and when that psychological moment in the economy happens where people just say, hey, I just got to cut this back. And then all of a sudden there's a drop in orders, there's a drop, and a lot of it might be construction led. Like a lot of times new construction in the U.S. or new construction in Canada, when you have interest rates this high, and it's hard to go, and then you have prices this high to build, it's hard to sell some new units. So the construction side of the economy and the auto side of the economy can start feeling the cracks first, and then it's just a slow bleed in. So I think we're talking a little. I'm kind of talking in circles on that, but I think it's really, we know that high interest rates have knock-on effects, but it's the time for it to work its way through the economy is not very easy to call right now.
All right, so we take all that stuff that's not very easy to call before the end of this year. Are we expecting at least one rate cut from the U.S. Federal Reserve?
Yeah, in TD Securities, in the fixed strategy team, we can see 2 this year.